Look at the story the numbers tell right now. The Federal Reserve has already cut rates twice in 2025, taking policy down toward the 4% range, even while inflation is still near 3%. The 10-year Treasury yield sits a little above 4%, the 2-year around 3.5%, and the yield curve, the gap between long and short rates, has finally turned positive again after years of inversion. On the surface, that looks like a soft landing script. Falling policy rates, moderating inflation, a yield curve that no longer screams recession ahead. Watch what happens when the camera zooms out. Beneath that calm surface, the system is rolling over trillions in old debt at today's higher rates. Treasury is launching giant quarterly refunding packages, raising new cash on top of refinancing. The machine is not slowing down, it is just changing gears. Check the simple promise for this video. Stay to the end for 3 concrete warning signs that separate a harmless soft landing from the kind of hard stop that turns small cracks into big breaks. That scoreboard comes right at the finish. Look at the first illusion. The Fed is cutting, so the danger is over. After holding rates at the highest levels in decades, the Fed finally started trimming in 2025, even as its preferred inflation gauges stayed close to 3%, and unemployment began to tick higher. That is not a victory lap. That is a central bank responding to stress on both sides of its mandate. Notice what that means in plain language. Inflation, the pace at which prices rise, has cooled from the peak, but it is still above target. The job market is no longer roaring, it is wobbling. The Fed is cutting not because everything is fine, but because pressure is building in the joints of the system. The result? Many investors read the headline, Fed starts easing cycle, and assume that lower rates automatically rebuild the old easy money world. The belief is that once the central bank blinks, asset prices are safe again. That belief is the first, don't fall for it. Picture it like a driver tapping the brakes at the top of a long hill. The car slows for a moment. Gravity has not gone away. The slope still runs all the way down. Watch the second illusion. Inflation is back under control, so the cost pressure is gone. Headline inflation has fallen from the extremes of 2022 to roughly 3% year over year. Goods prices have eased. Shipping is smoother. On the surface, it looks almost normal again. Check the contradiction inside that comfort. Services like medical care, household operations, and key everyday items are still rising faster than the average. At the same time, new tariff regimes are pushing import prices higher and reshaping supply chains. Falling goods inflation plus sticky service inflation, plus tariff pressure, is not a clean victory. It is a reshuffled burden. Translation: the system still pays more to keep the same standard of living. The pressure simply moves from one line item to another. Think of it like squeezing a balloon. The air does not disappear. It just bulges somewhere else. Small cracks become big breaks when people believe the balloon is flat. Look at the third illusion. The yield curve has healed, so the recession risk is gone. For much of the last 2 years, the classic 10-year minus 2-year Treasury spread stayed deeply negative, an inverted yield curve that has historically signaled recessions. Today, that spread has climbed back into positive territory, and the overall curve has turned upward sloping again. Notice the pattern in history. Often, the real economic damage arrives after the curve uninverts, not while it is still inverted. The inversion is the fire alarm. The steepening that follows is the smoke filling the hallway. When policymakers begin cutting, funding costs migrate, and weaker borrowers discover they locked in the wrong side of the cycle. The result? A positive curve today can coexist with rising default risk tomorrow. The signal does not say, all clear. It says, the next phase has started. Picture a doctor who stops the treatment because the fever drops from 40 degrees to 38.5. The patient is still sick. The chart just looks less alarming. So far, 3 illusions dominate the headlines. Cuts mean safety, cooler inflation means relief. A steeper curve means the storm has passed. The rest of the script shows why the plumbing of the system tells a harsher story. Watch what happens in the funding pipes. Each quarter, Treasury comes to market with massive refunding auctions, selling new 3-year, 10-year, and 30-year bonds. A big portion simply replaces maturing debt. Another slice raises fresh cash. At the same time, officials have signalled a preference for leaning more on short-term Treasury bills in coming years, while keeping longer-term coupon sizes roughly steady. Follow the money along that curve. Issuing more bills shift the burden toward frequent rollovers, refinancing old obligations with new short-dated debt. Rollover, replacing maturing debt with fresh borrowing, works fine when markets stay calm and rates keep falling. It is brutal when volatility spikes or buyers demand higher yields overnight. Why does that matter? Because interest costs compound. Net interest is already one of the fastest growing lines in the federal budget. Each time a short-term bill matures, in a world where rates are still near 4% and long yields are above 4%, the government resets another slice of the tab at today's higher price. Think of a household that keeps refinancing a huge credit card balance with 6-month teaser rates. It works as long as new offers appear. It breaks the moment the offers stop or the rate doubles. Small cracks become big breaks when the rollover window snaps shut. Check the long end of the market, because that is where quiet stress leaks out first. Several recent 30-year and 10-year bond auctions have tailed, meaning they cleared at yields slightly higher than traders expected going in. An auction tail, the gap between the expected yield and the final auction yield, means buyers demanded a bit more compensation at the last second. The result? Long-term borrowing has stayed possible, but only at a slightly higher rate than screens hinted. One auction does not break a system. A string of soft auctions in a world of rising supply and shifting buyers starts to matter. Picture an art auction where pieces still sell, but only after the seller quietly drops the reserve price again and again. Nothing looks wrong from the outside. The closing hammer keeps falling. Inside the room, everyone feels the change. What happens next if that pattern persists, while Treasury leans harder on short-term bills and keeps coupon sizes steady for at least the next several quarters? That is the open loop hanging over the next few auctions. Look at the calendar, because dates are now part of the risk map. Each monthly inflation release is a test of whether price growth is actually gliding toward 2% or stalling near 3%. Every Fed meeting is a decision point. Cut again, pause, or send a tougher message about inflation risk. Every quarterly refunding announcement lays out the new issuance roadmap, just as the easing cycle and tariff regime collide. Notice how those events line up. Inflation print, policy meeting, funding blueprint. Each one can shift yields, issuance plans, and the shape of the curve. Together they tell the story of whether the cracks stay small or turn into big breaks. Translation: time itself is now a risk factor. The system is walking from data release to meeting to refunding with very little slack in the rope. Watch the fourth illusion. If the data look fine today, the structure must be safe. Right now, equity indices still sit near recent highs. Credit spreads, the gap between corporate bond yields and treasuries, have not yet blown out. Volatility measures are elevated but not extreme. On paper, that mix looks manageable. Check the deeper mechanism. The entire structure rests on the assumption that there will always be enough demand at each new auction, at each rollover, at each coupon payment date, to keep borrowing costs contained. That demand historically came from a mix of domestic buyers, foreign central banks, and the Fed's own balance sheet. Today, the Fed is no longer a relentless net buyer of longer-term treasuries, and several foreign holders have slowed their accumulation of US debt. The pattern has appeared in every prior funding squeeze. First, investors shrug off higher yields as healthy normalization. Then one part of the system, mortgages in 2008, euro area sovereigns in 2000. May kunna si en tigin tada himas ikawa amont lamik fai gagin cousin far torrentation movi a kai sinin of a parent. Leveraged loans more recently hits a wall where refinancing no longer makes sense. Only afterward do markets reprice the whole curve. Think of a crowded theatre where the exits technically exist, but everyone assumes nobody will rush for the doors at once. The structure seems safe, right up until the first small panic. Look at the final illusion. Narratives change faster than math. New storylines appear almost every week. AI productivity will outgrow the debt. Tariffs will rebuild domestic industry without lasting cost. Lower rates will automatically restore the pre-pandemic playbook. Narratives move at the speed of social media. The math of compounding interest, rollover schedules, and auction supply moves at the speed of contracts. Follow the money instead of the slogans. Treasury plans to maintain coupon auctions while ramping bill issuance. The Fed is cutting cautiously, with internal debate and clear warnings that inflation is still above target. Inflation nowcasting still shows year-over-year price growth near 3%. Long-term auctions are clearing. But with softer demand signals than during the era of relentless central bank buying. The result? The system is not collapsing, it is tightening. Margins are thinner. Error bars are wider. The cost of being wrong about future rates or future demand is higher than it was when the curve was pinned near zero. So far, the picture is clear. Cuts have started, but not from a place of comfort. Inflation has cooled, but not to target. The curve has steepened, but under heavier debt loads and more frequent rollovers. Small cracks are visible. Whether they stay small or turn into big breaks depends on what happens around those recurring dates. Inflation releases, Fed meetings, and refunding announcements. Watch how to turn this into a simple mental dashboard. Not advice, just scaffolding. The story of "don't fall for it" reduces to 3 concrete warning signs. These are the signals that separate a gentle slowdown from a hard stop. Check the first warning sign: long-end auctions that keep tailing higher. If 30-year and 10-year auctions consistently clear above their when-issued yields and bid-to-cover ratios drift lower, that means the market is demanding a bigger term premium. The extra yield investors want for holding long bonds, for each new dollar of debt. That is not panic. It is the early stage of price discovery in a more crowded room. Notice the second warning sign: real yields. The interest rate minus inflation, grinding higher while growth data softens. When real yields push into the 2% range and stay there, borrowers pay more in inflation-adjusted terms, even if headline inflation looks under control. The combination of higher real yields and elevated rollover needs is exactly where small cracks have turned into big breaks in past cycles. Follow the money to the third warning sign: credit spreads widening while stock indices remain calm. If corporates suddenly have to pay much more above Treasury yields to issue new debt, that shows lenders getting nervous even before equity markets flinch. The gap between smooth equity charts and stressed credit markets has often been the last quiet moment before repricing. The result? The real story of the next year will not be written in social media narratives about pivot or soft landing. It will be written in auction tales, real yields, credit spreads, and the calendar of inflation releases, central bank meetings, and refunding announcements. Think of the system as a bridge. Hairline cracks do not matter much when traffic is light and speed is slow. When trucks get heavier, lanes get busier, and maintenance is delayed. Those same hairline cracks can become fault lines. The bridge still stands until it doesn't. Check the closing scoreboard, because this is where the illusions fall away. Scorecard, line 1. Policy rates are now lower than their peak, but still above inflation, and unemployment has risen, which means the Fed is cutting into a mixed backdrop, not a clean victory. Scorecard, line 2. The yield curve is no longer inverted, but long yields remain elevated, and Treasury is rolling ever larger piles of debt through a mix of steady coupon supply and heavier bill issuance. Scorecard, line 3. A repeating sequence of dates, monthly inflation prints, policy meetings, and quarterly refunding plans forms the next pressure test. Around those points, small cracks can stay contained, or they can become big breaks. Don't fall for the calm headline version of this story. Follow the plumbing, watch the calendar, and let them